Okay, so welcome back to this another video where we are covering the 14th topic of ESI, that is role of Indian banks and RBI in development process. So if you have not watched the previous 13 videos, I would suggest you to please go on the playlist section or the courses tab, and then you can find all the previous videos listed in a chronological manner. So let us get right into it. First we have role of RBI in the development process. Okay. RBI plays a crucial development role in India's economy beyond its traditional regulatory and monetary functions. RBI actively works to ensure adequate credit flow to productive sectors, strengthening the financial infrastructure and widening access to affordable and inclusive financial services. Rural credit. Timely credit requirement for agriculture, allied activities, housing, and small business. Key initiatives include priority sector lending. Okay, priority sector lending. I think we have studied priority sector lending previously, but then let us see. Priority sector lending includes agriculture, MSME, housing, education, health, renewable sectors, etc. PSL mandates ensure that remote and less developed states get formal finance, ensuring balanced regional development. At present, banks are required to lend at least 40%. Recent additions include startups, renewable energy projects, and social infrastructure. Lead bank scheme. This scheme is very much old. Under RBI assigns lead bank for each districts, and lead bank coordinates with district administration for promoting of financial inclusion, credit planning, implementation, etc. The scheme plays a key role in district credit plans. Okay. Kisan Credit Card Scheme (KCC) scheme was introduced with the objective of providing adequate and timely credit to the farmers for their agricultural operations. The government of India provides interest subvention of 2% and prompt repayment of incentive of 3% to the farmer, thus making credit availability cheaper and easier. What is this term called? Interest subvention. See, what interest subvention actually does is, suppose I am a farmer and I take a loan at an interest rate of 5 or 7%. Let us take example of 7%. So what happens is, government says that I would provide me interest subvention of 2%. So government pays, out of that 7%, government will pay 2% interest on my behalf. So the total interest that I would have to pay is just basically 7 minus 2%. That is how much? 5%. So 5% interest I have to pay out of my pocket, not 7%. So this is what basically is interest subvention of 2% means. Then we have export credit. Export credit. RBI plays an important role in promoting exports by ensuring the availability of affordable credit to exporters. Okay. RBI mandates banks to provide adequate export credit through EXIM Bank. EXIM Bank actually is like a specialized bank which gives you loans for expanding your export capability in general, and there are many benefits attached to it. MSME development. MSME are the backbone of India's economy. Collateral-free loans. That means no collateral is being engaged in the operations. Credit guarantee for MSMEs. Banks can provide loans without collateral or third-party guarantees. Bank codes for MSME customers. RBI has facilitated the formulation of banking codes and standards for MSME customers. These codes define minimum service standards. Okay, financial inclusion. Banking correspondents. Banks are allowed to appoint banking correspondents to provide basic banking services in unbanked and remote areas. Banking correspondents facilitate account opening. Okay, these are the people who go to rural districts and towns, and then they try to educate people. They help them in opening a bank account or making them a deposit in the respective banks. Expansion of rural banking infrastructure. Pradhan Mantri Jan Dhan Yojana. As a recent data, over 50 crore Jan Dhan accounts have been opened with significant participation of women and rural households. RuPay debit cards. with accidental death and disability coverage. Aadhaar enabled payment system, a bank-led digital payment model that allows transactions through Aadhaar authentication at POS terminal operated by BCs, that is uh, banking correspondents. Payment banks and small finance banks introduced to deepen financial inclusion by serving small savers, migrant workers, and micro enterprises. Digital payment infrastructure. RBI has played a transformative role in digital payment infrastructure. We have UPI 2.0 with advanced features such as overdraft linkage, payment systems such as NEFT, RTGS, IMPS, NACH. Introduction of Bharat QR, single interoperable QR code, reduction in merchant discount rate. Payment Infrastructure Development Fund PIDF, objective to increase digital payment acceptance infrastructure, reduce cash usage, and promote financial inclusion. Focus area: Tier 3 to Tier 6 cities, northeastern states, Union Territories of Jammu Kashmir. Funding: initial corpus of 500 crores with RBI contributing 250 crores, and rest from card networks issuing banks. Infrastructure covered: physical, digital. Management: governed by an advisory council set up by RBI. Target is to create 30 lakh new acceptance touchpoints. Extension extended for 2 years. Foreign exchange management, FEMA. This is very important. Empowers RBI to regulate foreign exchange transactions. RBI powers include regulation of foreign exchange payments, export and import of currency and bullion, transfer of securities between residents and non-residents, acquisition of foreign securities, purchase of immovable property in India and abroad. Money market regulation. It regulates through these mechanisms: CRR, repo and reverse repo, marginal standing facility, and bank rate. Inflation control. So RBI is mandated to target inflation by 4 plus minus 2%. That means either it can be from 2 to 6%. Inflation control is crucial because high inflation reduces purchasing power, distorts income distribution, raising borrowing costs, and creates uncertainty in economy. Then we have very low inflation may result in unemployment and reduced industrial incentives. Role of banks in the development process. Let us see. Credit creation. Yes, banks helps in credit creation. For example, if a bank receives 10,000 rupees deposits, and maintains a 10% reserve, it can lend 9,000 rupees extra into the economy. Transfer from surplus to deficit sectors. Banks mobilize savings from surplus units and tend to deficit units. This stimulates demand, investment in infrastructure, job creation, and industrial expansion. Okay. Priority sector lending by banks. Banks lend to education, housing, then for MSMEs, etc. Startups and renewable energy projects have been recently included. Yes. Digital transformation by banks. Banks have significantly contributed to digitalization via Digital Apnayan Abhiyan, Bot, iLead portal, iMobile app, Kia virtual assistant, EVA chatbot. Industrial and development banks. Institutions like SIDBI and NABARD support industrialization, MSME, and rural development. They provide long-term finance, refinance facilities, and policy support. Formalization of lending. Banks expand branches in unbanked areas, reducing dependence on informal money lenders. Then, which protects household from exploitative interest rate. Okay. Implementation of government schemes. Banks are key implementing agencies for schemes such as Atal Pension Yojana, Atal National Pension System, PMJDY, Jan Dhan Yojana, and Direct Benefit Transfer (DBT), enhancing domestic savings. Banks channel small savings through schemes such as Sukanya Samriddhi Account, Public Provident Fund, Senior Citizen Savings Scheme, and Office Savings Schemes. So, I think that was it for this topic of Indian role of Indian banks and RBI in development process. Yeah, so stay tuned for the rest of the topics, and thank you for watching.